This is only available on the estate builder. It's not offered in the wealth accumulator. And as I've mentioned in the past, the limited 10 pay, in my opinion, has a very select market. I strongly believe that the product is mainly geared towards the affluent high net worth clients that may have additional income and have excess money that they can put into a policy that's going to be paid up in 10 years. Now, interestingly enough, and this is part of the reason that I wanted to share it, where I have seen the 10 pay actually be used and extremely competitive in today's environment, I have seen the 10 pay being used with the enhanced protection option, both in a high net worth case and with juveniles, because we are one of the few companies that actually allow the enhanced coverage option on the 10 pay product. And that's really where I want to highlight some of the key differences with that. If you haven't looked at the 10 pay, I urge you to look at the 10 pay specifically with the enhancement, because I've seen us be very competitive in that market space. Where I have seen it used again is we've had, surprisingly, a lot of grandparents that are looking to put this in place for grandchildren, because the 10 pay, having the policy paid up in 10 years, is extremely appealing to them. And so that's something to consider as well. With CI, this is something that I continue to get asked questions on. How do you compare against this company? The last question that I got was, how do you compare against Humania with respect to juvenile whole life insurance? And so we revamped the product. Equiliving underwent some significant improvements that not only brought us in line with some of the other companies, but it made us more competitive. And so I want to remind you about some of the key CI enhancements that we put in. We removed the 30-day survival period for non-cardiovascular conditions. What that means is if you are diagnosed with cancer, you don't have to wait 30 days to file a claim. As long as the definition is met, your client now has the ability to claim significantly faster, which leads me to the next point. I've been asked as well about our claims process. A couple of folks have heard that our claims process was more difficult than some of the other companies out there. That's not the case. Simply, when a client gets diagnosed with a critical illness condition, either you as their advisor or the client calls the customer service team and they send out the necessary forms required to start the claims process. So it's very easy to file a claim with Equitable Life. With the product itself, what I have seen a big draw to is the limited pay options. So if you recall, we introduced the limited pay plan, limited pay for 20 years to age 75, limited pay for 20 years to age 100. And where I have seen that being used over the last month and a bit since the product was introduced is adding CI as a rider to some of those contracts for whole life where the children are being insured, or where they're looking at somebody who is in their mid 20s to mid 30s. Because in the past, adding a CI rider meant that the whole life policy was paid in 20 years, but the CI premiums continued. Now we have a product that is truly paid up at the end of the 20th year, which lines up nicely with the 20 pay participating whole life insurance contract as well. Key differentiator, acquired brain injury, extremely competitive. We will allow claims to happen due to external trauma, due to asphyxiation, due to an illness that leads to acquired brain injury. Currently, Sun Life is the only other company that offers this benefit. We also added the early detection benefits, meaning that your clients have the ability to claim on more early intervention benefits. They can claim up to once per early intervention, and it does not reduce the critical illness insurance benefit amount. More importantly, with loss of independence, again, focusing on key differentiators. First and foremost, it's included in the contract and it is not a rider. Second of all, with many of our peers, the minimum age to claim on loss of independence is age 18. We don't have that restriction. So we can actually file a loss of independence claim for somebody who is younger. For juveniles specifically, and this came up in the conversation with the advisor with respect to Humania, we will consider a child as early as 30 days old to age 17. and we don't limit the CI face amount as long as it can be financially justified. Because I know that Humania, along with some of the other companies, when it comes to juvenile CI, they do end up capping the maximum amount of CI that an individual could purchase. Nima, I know you and I talked about this, but I will share it for the benefit of the group. If you didn't see the email that came out over the weekend, as of April the 2nd, we released new illustration software. The new illustration software is 2022-2. The products have not changed, but our underwriting guidelines have changed, and for the better. One of the things we've done, keeping in line with some of the other companies in the industry, we have increased our non-medical limits. This is the biggest increase in Equitable Life's history, and it's putting us near the top of the industry with respect to non-medical limits. We've also updated our evidence of insurability table. But the reason that I bring up the software is because in the past, during the pandemic, when we introduced the non-medical limits up to $1 million, the software was never updated to reflect those changes because we didn't know at the time if they were going to be temporary or if they were going to be permanent. And so the changes that we have today are on the screen for you now. We will consider up to $3 million for individuals between the ages of 18 to 50. 500,000 for 51 to 55, and 100,000 for 56 to 60 on a non-medical basis. 3 million is a lot. Many of the peer companies in the industry promote amounts of 5 million that are obviously higher and more appealing. Having said that, there's a big distinction between a non-medical and between no fluid underwriting. And I share this from experience. I had an advisor say to me not too long ago that most of his business had been going to Sun Life because Sun Life had a higher non-medical limit up to $5 million. But he continued to get APSs on all of the files that were being submitted. And that's because there's a big distinction between non-medical, meaning no fluids, no APSs, no additional information, versus no fluid, which means no blood vital, no blood, no urine. But the company still reserves the right to continuously ask for APSs and additional medical information. That is a big key differentiator. And 3 million really puts us near the top of the tier with respect to non-medical underwriting. Of course, we updated our table. One of the big changes that we made to the table is that you can see, in the past, the banding was set at 0 to 99,999. We've rounded all that up. And so I suggest you get the most up-to-date evidence of insurability table for you to look at as well. We also brought back preferred term limits. So one of the changes that took place and that happened over the weekend was we updated the Easy Complete online application with an additional question with respect to preferred underwriting. And so if you recall, preferred underwriting was not available for $1 million. It was actually available for amounts that were over and above 1 million. And so now for insurance policies that are equal to or greater than $1 million for individuals 18 to 50, there's a question on the online application that asks if you want us to consider the individual for preferred rates on term. If the answer is yes, there is going to be additional medical evidence that is required for the preferred term consideration. So we're really putting this in your hands. Do you want the client to be underwritten for preferred rates? In which case, we're probably going to need blood, urine, vitals. Or would you prefer that they go for standard rates up to $3 million on a non-medical basis? Very competitive, okay? The other thing that we've done is Easy Complete. So with the increased non-medical limits, this has led to faster turnaround times in our Easy Complete automated process. Remember, when we introduced our online application system, the goal was to introduce an application system that would also, in the background, underwrite clients automatically. And what we have seen is that we have seen applications from submission to commission on average being turned around in about 11 days. That's significant. With some of the juvenile cases, we've seen those applications going through, being approved sometimes within a day. That's fantastic. And so the hope is that with these underwriting increases and with the increase in digitization, we're going to be able to provide policies from submission to commission significantly faster. This allows us to focus on the mid market, the bread and butter that has brought Equitable Life so much success. But because we are automating and digitizing and increasing our non medical limits, this positions us extremely well from an underwriting perspective to be a service leader in the high net worth market space. Because what this has done now is it frees up time for the underwriters to focus on those more complex, large scale cases when we go through underwriting. So, in my opinion, extremely good news. And if you missed the announcement that came out, hopefully I've brought you up to speed on that today. And so, individual insurance as a creative tool, I know that there's people that have been in the industry for a number of years. There's new people in the industry that maybe recently just got their license. Tim Sesnick is an individual that writes for the Globe and Mail. In 2012, he wrote an article about 8 ways that life insurance can help your clients. He revived it in 2016 and also added some additional ways that life insurance can help your clients. And so I thought I would put some of those reasons into a presentation format that really give you the opportunity to talk to clients about how insurance is a creative tool. Because the reality is this: right now, financial advice is readily available for everybody. I can Google something online that talks about financial planning and investing, and things will come up, so much so that people feel they can do it independently. Of course, people talk to their friends, they talk to family members, they read books or magazines. But here's the reality. And this goes back to a LIMRA study that was conducted. I think I shared those statistics with you last year. Regardless of information being readily available, the facts continue to be clear, and the facts point to individuals working with professional advisors as one of the best investments a client can make to secure their financial future. The challenging part is trust isn't easily earned, right? And there is no place where I think that is more true than in the financial services industry. I bring this up because in conversation, right, whether it's a family gathering or a friendly setting, or you're at a function with people that are outside of the industry, very few people in our industry, when asked, what do you do for a living, say, I sell life insurance. Because as soon as those words come out of your mouth, for some people, their backs go up, their defenses go up, because there's a very bad connotation about life insurance salespeople. We try to demystify that. And as you've heard me say in the past, I think and I believe in empowering clients through education by giving them the necessary tools to make informed decisions about their overall well being. Now, as advisors, I think it's increasingly important to communicate with clients and prospective clients about how your expertise and experience provide significant added value that they just won't find anywhere else. And oftentimes, when we talk, if you've connected with me, I will share experiences on cases that I worked on before and how things have transpired if it's called for. If it's not called for, then we're going to work on cases together and really try to figure out whether or not it fits. Now, here's the reality that a lot of people don't see. People see insurance as an expense. They don't see insurance as an asset. And that I think is one of the biggest drawbacks that people's mentality when it comes to insurance, because we know that insurance is a useful tool to help safeguard assets of an individual against the unexpected death. Now, because insurance is traditionally seen as a cost and not as an investment, people lean towards the cheapest solution to cover the liability. Think about all of the marketing and advertising that goes on. Think about the last commercial that you saw about purchasing insurance. It wasn't about the financial planning aspect. It was about how cheaply you could obtain life insurance for less than the cost of a cup of coffee for less than pennies a day. It shouldn't be focused on the cost, because the truth is that individual insurance is an extremely valuable tool in tax and estate planning. We've shared this slide before. It's not surprising that more and more of Canada's wealthiest individuals turn to participating whole life insurance to protect their estates and address tax issues, because as much as we accumulate, the reality is that in retirement, we probably have more than we need to live off from. And there's a lot of those assets that are going to be passed to future generations. And we've talked about this before, the intergenerational transfer of wealth that is going to happen over the next 5 years. And I think that used well, individual insurance provides an opportunity to enhance your personal balance sheet by minimizing taxes and enhancing liquidity at a time when a family needs it the most. But as we know, life insurance isn't always an option because you need to be healthy. And so the question to clients, the question to you is, how are your goals going to be impacted if you die too soon, if you become disabled, or more importantly, if you outlive your money? Because there's a lot of people that aren't necessarily high net worth and they're doing all the right things, planning for retirement to ensure that they live a comfortable lifestyle. But what if you outlive that money? What if you have more life? And this is where we need to start planning for longer periods of time. Here's the key: life insurance helps. Why? Because life is usually, or lifestyle is usually influenced by income level. And income level is usually influenced by the ability to work. And so, in other words, and Amy, you'd remember Garrick from Canada Life. Garrick used to say this all the time: your health is your wealth. And income level is often the main influence as to the type of lifestyle that somebody wants to lead. And to earn an income, you have to work. And so, why does insurance help? Well, if someone dies prematurely, suffers a critical illness, or is no longer able to work, their lifestyle and their family's future lifestyle may be impacted in a significant way. When we talk to clients, the idea is to plan for the best and prepare for the unexpected, because we know that the cheapest time to buy life insurance is when you least expect to need it. And this is where I take a spin on those commercials, because those commercials are always, you can buy insurance for pennies a day. Well, you can buy insurance for pennies a day today. And it doesn't matter what the product is, because the cheapest time to buy the product is today when you least expect to need it. Now, we know the amount of insurance a client needs is going to change over time based on some of the goals that we're seeing in this chart, but it's an excellent value at any time of your life because of the fundamental protection that it provides. And you can tailor a solution to meet changing needs and the budgets of a client. Now, the truth is this: life insurance is an extremely valuable tool. As I mentioned, is tax and estate planning. It can be used in many effective ways and shouldn't be dismissed so quickly. So let's take a look at some of the key reasons. Life insurance is a vital part because when you die, life insurance can cover final expenses, it can pay off debts, it can ensure your family maintains their standard of living. We also know that when you're alive, life insurance can be used for a number of ways, but not a lot of people know that. So here are some of the key reasons I want to focus on. When clients have liabilities, as I mentioned before, and they look to cover the liability in the event of death, the immediate reaction is to find or focus on the cheapest way of doing that. Now, there are other ways to help cover that liability. And sometimes people try to invest the money to save. Now, helping cover the liability with insurance is often seen as an expense that is going to reduce cash flow, which it could be used for other business ventures. This is what we call that proverbial opportunity cost. Now, one option, as I mentioned, is to invest the money in the hopes of maximizing the return. But as we know, this can lead to different tax implications for your client's portfolio because all investment vehicles are taxed at different rates. We've also come across a lot of individuals that like to invest in real estate. And my comment to those individuals is, if you're primarily invested in real estate or a private company or other illiquid assets, where is the cash going to come from to pay the taxes owing when you are gone? Life insurance can solve that problem. Here's the tax need. This need deals with assisting your clients to deal with an estate tax liability at death. Ensuring your clients understand the tax liabilities their estate may face on death can help to sell this concept. Whole life insurance may be useful for those who want to pass the family cottage or other real estate assets to the next generation, because we have seen and have heard of many horror stories about families who have had to sell their cottage, one that has been in the family for generations, because they could not afford the taxes due on death. This is part of the reason that those family offices exist, because it's all about tax and estate planning and mitigating taxes long term. So let's take a look at a quick example. Let's see how a joint last to die policy can help the following couple. Here we have a male who is 51 and a female who is 53. They have registered savings of $400,000, non-registered savings of $325,000, and a cottage that has grown modestly over the last number of years. If we take a conservative growth of 5% annually, the value in 30 years of this property is going to be $1.2 million. The gain, based on the fair market value and what they paid for it, is about 1.1. The taxable gain is $562,000. And as it stands today, with capital gains being set at 50%, the tax liability is about $281,000, just over $281,000. This is assuming capital gains tax stays at 50%, because we've all heard the proposed capital gains tax potentially going up as high as 70%. And so based on these numbers, they anticipate the need to cover a $300,000 tax liability on the death of the surviving spouse. An Equimax joint last to die policy may be an ideal solution to keep the cottage in the family. Using some of the non-registered assets to pay the premiums won't disrupt their current cash flow, and funds in a permanent insurance plan are going to grow on a tax advantage basis. What I like about this idea is that for less than 2% of their non-registered assets, the clients can protect their estate by transferring a taxable non-registered asset to a tax-exempt life insurance policy. I had an MGA that ran a campaign for a year around the 2% solution. Do you want to know what that 2% solution was? This idea right here. The fact that for less than 2% of your non-registered portfolio or of your investment portfolio, we can mitigate risk by incorporating life insurance into the mix. And it doesn't have to be life insurance. It could be critical illness. It could be disability. It could be a number of things. But the key here is helping to mitigate tax long term. Also, life insurance provides income where you can't. Think about a situation where you're talking to the primary breadwinner in the family, or think about your own situation. Are you the primary breadwinner in the family? If you're no longer around, life insurance can create an investment portfolio to replace that income that may be important to the security of your family. It also helps to eliminate debt at an important time. If you have debt, do your loved ones a favor, buy insurance, secure that financial plan, because when you pass away, paying off the debt with life insurance proceeds is going to put your family in a better position. How many of us have seen GoFundMe pages? GoFundMe pages, through the donation of many individuals, provides money at a time when people need it the most. Isn't that what insurance does? It provides income when you can't. Individually owned insurance provides certainty in uncertain times. It provides us the comfort of knowing that in the case of an early or untimely death, our family members are going to have the funding necessary to fulfill any and all obligations or goals that they might have. Insurance also helps to shelter investments from tax. We've had this conversation a number of times with respect to some of the advantages of permanent participating whole life insurance, because it is an immediate estate enhancement, and the opportunity for tax advantage growth means that the clients have the ability to grow an additional nest egg that they can draw from in retirement. See, tax exposed investments are good from the standpoint of compounded growth and you benefit long term. However, taxes on the investment income erode investment growth every single year. And this tax run is the reverse of compound growth. It's a compound reduction and can dramatically reduce the client cash or the cash that the beneficiaries are going to receive. Now, RRSPs and tax-free savings accounts, they help to avoid or defer some of the taxation. And putting taxes off means that more money stays invested for your clients. However, like all good things, tax deferrals typically come to an end. And at some point in the future, there's going to be tax realized specifically in an RRSP. In addition to that, both are quite limited in how much can be contributed each year. So once those contributions are maximized, and especially in the high net worth environment, a client is going to find that his or her investment options inevitably defer back to a tax exposed environment that is a non-registered portfolio. Now, why is this a problem and why do people not see it? Here, we're looking at a 50-year-old male that put in $5,000 deposit on an annual basis into this non-registered portfolio at a growth rate of 4% every single year. And I assume the 40% marginal tax bracket. Assuming there are no withdrawals coming from this portfolio, pre-tax, this portfolio is going to grow to about $412,000. However, when the individual passes away at age 85, after taxes net to the estate, we have $218,000 left. A $200,000 tax bill, in my opinion, is significant and one that many clients would likely try to avoid. However, many of the average client, for lack of better terminology, they don't see this problem. The reason they don't see this problem is because we've been conditioned to look at numbers year after year and the growth potential that it has. And so when you invest $5,000 a year, even if you take the growth into consideration and maybe you take some of that money out to pay the taxes, if at the end of the year you have more than $5,000, that seems like a good deal, right? And if at the end of 20 years you have more than what you put in, that seems like a good deal. However, when you take into consideration the cumulative tax bill over the last 30, 25, 40 years, that's a significant chunk of change that is going to go to taxes. And so life insurance helps to shelter that tax. It's a valuable part of your client's portfolio. It's a unique asset class because of the estate enhancement and the opportunity for the tax advantage growth. This is where we include life insurance as part of the overall investment portfolio for a client or for a corporate business owner. Here's two key points that I focus on when it comes to insurance. Other than the growth and the risk and the access to cash, tax treatment, so it's tax-free. It also allows for a tax-free transfer of assets when the individual passes away. Why? Because if it's going to go to a named beneficiary, those proceeds flow tax-free. If the policy is owned corporately, we know that inside a corporation, the policy proceeds are going to pay tax-free, and it creates a credit to the capital dividend account, allowing the client to extract money from the company tax-free. It also provides a legacy of value. Here's where we talked about the great wealth transfer, right? This term has been coined by several major wealth managers across North America. And what it's referring to is the tremendous amount of wealth that is going to be transferred to younger generations over the next 5 years. Now, people traditionally would inherit their parents' assets after they pass away, at which time there's also a tax liability to the estate and potential probate fees. If you attended the weekly business builder last week that we hold on Thursday, we talked about the intergenerational wealth transfer and how there's a number of ways that you can transfer wealth to the next generation. I'm going to talk about a couple of points that weren't really discussed in more detail. So there are a number of ways to transfer wealth. One is to include them in the will. Okay. Now, taxable investments will continue to cost your clients money in taxes, even if they are included in the will. Okay. The other component is this: they, when I say they, I mean the people transferring the wealth, will not see the impact of their financial gift because it is not going to happen until they die. Secondly, their loved ones could wait a long time to receive value from their estate, right? I knew somebody extremely well who always used to say, my mother-in-law says that when they die, I'm going to get the money. My mother-in-law says that when they die, my wife and I are going to inherit the money. And his answer was, he used he used something that I don't want to say online. He says, I don't need the money when they die. I need the money now. And so there is the chance that an individual is going to have to wait a long time to receive the value of the estate. And when they receive it, it's possible that maybe at that point they don't really need it. It's always welcome, but they could have used it at a much earlier stage in life. Also, one of the challenges of having this included in the will is that people need to ensure their will is always up to date. We've come across many people, first of all, who don't have a will, and second of all, if they do have one, it's significantly outdated. The other component to keep in mind is that each province has a different set of rules regarding inheritances and estate management at death. In addition to that, some creditors may have rights to your client's money first before their heirs. And so you can see some of the challenges in including this transfer of wealth in a will. Option two is to transfer wealth to loved ones while living using life insurance. The preferred approach if your client wants a certain outcome. The example here is, a client wants to make sure that their grandchildren have the money to go to university, or that their adult children may buy a home or business and will have the money they need when the time comes. Why consider the wealth transfer through life insurance? Well, we've seen this time and time again. Some clients have purchased insurance on the lives of their children, one, because it's cheaper than on their own lives. And once the kids are 18 or older, they can transfer the ownership of those policies, including the assets in the policy and all the growth to their kids tax-free. By building cash value in this permanent life insurance policy, your client may achieve tax-preferred growth. And if the assets remain in taxable investments, such as a public company, bonds, or real estate, rather than being deposited into a life insurance policy, income on those investments would be taxable, either annually or upon disposition, or sometimes both. Moreover, life insurance death benefit doesn't form part of the estate if there's a named beneficiary. The death benefit would not be subject to probate fees and taxes, as I mentioned before, and this truly provides a tax-free legacy for future generations. And so we walk through the example of Walter, a 66-year-old male, recently sold his business that he built from the ground up for the last 30 years. He is enjoying retirement and is secure financially. He doesn't need the money from the sale of his business to sustain his retirement lifestyle. He has all of his money in a taxable investment, but he's a little bit worried about the potential tax impact of his current savings and in the future. And of course, any probate fees that the estate may have to pay. This gentleman, if you ask me, is the ideal candidate for the intergenerational wealth transfer strategy that uses life insurance. He is affluent, doesn't need the money for retirement and lifestyle, and sometimes they may have insurance in place already for their own personal situations. But this is also long-term planning, right? And it's planning about the impact that the taxes could have on his loved ones. And so designing a long-lasting plan is going to help meet those obligations. And how do we do that? Well, here's what we're looking at, right? He wants to minimize his taxes. He wants to maximize what he leaves for his daughter, Christine, and her family. He would like to provide a long-lasting legacy for Christine and her children, and wants a well-designed intergenerational transfer plan that is going to help minimize taxes today, but augment the value of the estate that he leaves behind. And so very simply, we use the illustration We know that he wants to commit $50,000 a year, which is going to include the maximum deposit option. We put that into the software, we solve for the death benefit, and that spits out approximately $1.3 million of insurance. Christine, the daughter, is going to be the life insured and contingent policy owner. And if Walter passes away or chooses to relinquish his ownership, then Christine will become the policy owner with no tax consequences. It's important to keep in mind that Christine has to be named as the contingent owner. Okay? After 10 years of premium payments, Walter's going to stop because we're going to use a premium offset. And at that time, if he chose to, he can transfer the ownership of the policy to his daughter, Christine, whenever he is ready, without, again, any tax consequences. And the key behind this strategy is this: Walter's grandchildren will be the named policy beneficiaries, so that when Christine dies, they will equally share the tax-free life insurance proceeds from this policy. And in case the children are minors, then we have Christine's husband that we can name as a trustee, or somebody else that the family relies upon to oversee the finances for the kids. So here's the result. Christine is the second generation that will benefit from this transfer strategy. Why? Because when she becomes the policy owner after 10 years, she will have access to the policy's cash value and may use it at any time and for any reason, whether it's trying to help her kids through post-secondary education or maybe putting down money for deposit on a property. The kids is the third generation that benefits from this. Why? Well, because if Christine should die, they will equally share in the tax-free life insurance death benefit proceeds. And if she happens to die when they're minors, then we know we have the advantage of the trustee. So here are the results. By Christine's age 50, which is 16 years, the illustration shows a value, cash value, of $451,000, which can continue to grow over time until it is withdrawn or until it's borrowed against. And as you know, the cash value can be accessed whenever the policy owner chooses. The life insurance death benefit, of course, continues to grow as well. And the illustration shows a death benefit that may reach over $3.6 million by Christine's age 85 and over $4.3 million by 95. And so as beneficiaries, Christine's children will eventually receive the significant death benefit tax-free. You can see why this is an exemplified or turbocharged intergenerational wealth transfer strategy, because it is hitting 3 generations of the family. While Walter is alive, he has control of the policy. He can do whatever he wants with it. When he passes away or the transfer goes to Christine, Christine now has access to the values and she can do whatever she wants with it. So there's a good way to leave a legacy for the family. It also helps to provide cash in retirement. And so although the primary purpose for life insurance is to protect and mitigate risk, the beauty of permanent cash value life insurance is that you have an asset that can help you later in retirement. Here's the case study that I just walked through when I was doing the weekly business builder. And this is something that I've covered in the past, but I think it's important to bring up again, because the more we continue to talk about this, the more and more I hear the objection of buying term and invest the difference. And so this case study shows how having a permanent life insurance policy in place allows a client to spend down all of their investment capital without having to earmark any of it as an inheritance. And we're going to compare 2 results. John, who is going to pay less premium to buy term and invest the difference, and Bill, who is going to pay a higher premium to buy participating whole life insurance policy and is going to have less money to invest. So here are the assumptions that we use for this strategy, okay? Both are 45. They're looking for a tax efficient way to build wealth. They want to leave an inheritance. At the same time, they want to take income. We're going to make the assumption that they've maximized their RRSPs. They currently have $750,000 in a non-registered investment vehicle. And it assumes a 5% rate of return that will continue until age 85 with no withdrawals being made until 65. They can afford to spend $30,000 a year for the next 20 years. Now, the great thing about this case study is that the numbers are scalable. And so It doesn't have to be 30,000. It could be 10,000 or it could be 50,000. I think the concept is the concept. So here's two solutions. John is going to buy $1 million of term that is not going to be renewed. Bill is going to buy a combination of Equimax whole life insurance and 20-year term rider. Again, $1 million that is not going to be renewed. And the premium contribution is going to look like this. John is going to buy $1 million of term 20 for $1,700 versus Bill, who's going to spend $23,000 on insurance and invest $6,000. You can see that if the conversation stops there, and this is why those commercials about buying insurance for cheaper doesn't do the planning aspect of it any justice. Because if a client looked at this, they would say, why would I spend $23,000 for $1 million when I can buy it for $1,700, right? Assuming the term again is not renewed and we have a 5% rate of return, and this continues to age 85 with a 53% marginal tax rate, John is going to have a net estate value of $1.9 million at age 65, and Bill is going to have a net estate value of $2.8 million, which takes into consideration the insurance that was purchased and the growth on the non-registered investment that he had. The results are that both achieve their goals. They leave an inheritance and they have access to money for retirement. However, Bill has the ability to withdraw almost twice as much money every year. John can only withdraw $44,000, whereas Bill has the ability to draw 90% more income each and every single year for John. Why the difference? Well, John's withdrawals are going to be limited to the interest earned on his savings in order to keep $1.9 million of principal intact for the beneficiaries. Whereas Bill has the insurance to backfill what he wanted to leave behind, and so he can spend down all of his capital. The question to a client, the question to you is, who would you rather be? I think a whole life insurance policy gives your clients the freedom to spend their wealth by eliminating the need to earmark assets that they leave behind. And so let's take a deep dive into the math, because I know I didn't really cover the mathematics as we were going through it. So John's plan, again, he's maximized his RSPs. He's got $750,000 of non-registered investments. He's going to spend $30,000 a year, meaning $28,000 of that is going to go towards the investment. Here you see his investment growing to $1.9 million. However, when John retires at age 65, the intent is to leave $1.9 million intact as a legacy for his heirs. And so at a rate of 5%, John has the ability to withdraw or, to help supplement retirement income of $44,000 a year. Conversely, Bill, on the other hand, is going to be spending less on the investment, or he's going to contribute less to the investment. He's going to spend a little bit more on insurance. And his non-registered portfolio is going to grow to about $1.3 million as well. Okay. When Bill retires at age 65, he can spend down the $1.3 million without blinking an eye, because the life insurance gives Bill the permission to spend more in retirement and still leave a legacy to his heirs. Now, assuming Bill dies at age 85, there's going to be $2.4 million of insurance. Again, using current dividend scale interest rates. If we examine the cash value projections, you can see that the insurance also has additional cash values that Bill can draw from if he has too much life at the end of his money, or if he lives longer than age 85, which is what we're going to address next. So what if Bill lives beyond age 85? What happens at that point in time? We know that planning to age 85 is not prudent. Now, here's a strategy that takes away from leveraging and borrowing or policy loans. The approximate annual dividend growth in a policy is calculated by looking at the change in cash value of paid up additions from age 85 to 86. The illustration isn't here, but you got to trust me on the numbers, okay? So Bill's whole life policy has the following values at age 85. Cash value of paid up additions, and you can see this in the cash value report on the illustration. The cash values of paid up additions is $1.4 million. And that's calculated as the total cash value minus the guaranteed cash value. At age 86, the cash value of the paid up additions is now 1.5. Again, total cash value minus guaranteed cash value. What this tells me is that the growth in the cash value of paid up additions is approximately $84,000 a year. If Bill wanted to, he could take that dividend growth of $84,000 a year and take that payment as a cash dividend payment. I understand that it's taxable, but here's where the cash dividend payment option makes sense. You wouldn't do it in the early years of the contract because the growth is so minimal. But later in life, if you have a client in their 80s, and at that point, let's be honest, I don't see a lot of folks leveraging. I don't see a lot of folks doing policy loans, but I do see a lot of folks looking at a potential policy withdrawal. And so if you could take the $84,000, even after taxes, let's say they're in a 50% marginal tax rate, you're ending up with $42,000 net of tax. And your policy will remain at that point in time where it's at. That's a good deal for the client if they live beyond age 85. The other option is that Bill can take less, but for a much longer period of time, right? John is withdrawing the interest only in order to leave his principal intact as his estate. So he's going to take out the 44,000 that we've talked about. Previously, Bill was taking out more money. He was taking approximately $83,000 for 20 years, and he can exhaust the funds in his non-registered investment. Let's assume Bill takes less income for an extra 10 years until he's 95. So he takes $61,000 a year, which is 40% more than John, who is still only drawing the interest from his non-registered investment. And after 30 years, Bill has withdrawn 40% more income than John, and the estate provided by his whole life insurance policy is almost 73% higher than John's. Simply by having a permanent life insurance policy in place and without having to access the cash value of his policy, Bill can withdraw almost twice as much money at retirement than John, while leaving slightly more money to his heirs. The bottom line is this, folks. Adding a participating whole life insurance policy to your client's portfolio gives them more freedom and options throughout their retirement years. I feel that a financial plan that includes investments as well as an exempt permanent life insurance policy can provide a client with access to more money to supplement their retirement income without the need to leverage the life insurance policy as collateral, because you can always change to a cash payment. There are a couple of other ways that life insurance helps your clients. I'm not going to talk about these too much today. They are in the article as well. But here's a couple of other ways that we talked about before. And again, it leads to the estate planning aspect of it, right? State equalization. So life insurance helps to equalize your estate. Equally dividing up an estate between several heirs often leads to conflict. Family members sometimes feel that they have been cheated or they didn't receive their fair share. And cash from a life insurance policy can be used to ensure that everybody is treated equally. An example of this is we worked on a case last year where, we had a successful business owner, had two kids, a son and a daughter. Both worked in the business, but the reality was that the daughter didn't really want to inherit the business. She wasn't keen on continuing that. The son, however, wanted to inherit the assets of the business. He wanted to continue to work in the business. And so the agreement that was reached was that the son would inherit the business and all of the assets, and insurance was used to equalize the value of the estate. And insurance was purchased to ensure that the daughter would end up receiving the insurance proceeds when the individual passed away. Another way that insurance helps is to make meaningful donations. We all want to donate to charity or help a worthy cause, but many times we find that our cash flow doesn't allow us or give us as much as we would like. And so proceeds from life insurance policies may be a better answer. You can donate all or part of your policy death benefit to the charity of your choice, really helping to increase the value of that charitable donation. Of course, it also ensures business continuity. We continue to see this in the business owned space where we're talking about buy sales, we're talking about business succession, key person protection. A business can be greatly affected when a key person suddenly dies, and life insurance can help keep your business running after you're gone. It can provide the funds needed to cover overhead and train a replacement until the business can be stabilized. If your company owns and is the beneficiary of a life insurance policy on your life, the company receives a tax-free payment of the proceeds when you die. And as we've talked about before, these proceeds are going to increase the capital dividend account credit of the company, which allows for a tax-free transfer of dividends to the surviving shareholder. This talks to the last point. It enables for tax-free withdrawals from your corporation. So the message here is think about life insurance not as an unnecessary cost, but as an investment to accomplish something important and something beneficial that is going to help both during your lifetime and when you're gone. The last thing I will leave you with is, consider this. So this conversation stemmed from a chat that I was having with another advisor. And this really speaks to the critical illness insurance aspect of it. He said, Rudy, I talk about critical illness all the time, but I had a very difficult time talking to a client who is considered to be high net worth. And so this is a calculator that I've used for quite some time. It is not Equitable Life branded. I used to use this back when I was at Canada Life. And what it does is it helps with the critical illness insurance conversation. And here's what we look at. The individual he was talking to said, I've heard about critical illness insurance, but I'm okay. I think I can save for that. And I have enough money to be able to help me if something were to happen to me. And so walking through this calculator, I gave the advisor a couple of talking points. Let's assume the individual you're talking to is 45. Okay. Let's assume that the age at onset of an illness happens to be when this individual is 60 years old. Okay. And let's assume that the amount of money required at that point in time was $150,000 to help supplement income for a year. If we take a look at a savings account where you're going to contribute to this, what we are looking at is, let me move this so we can see the numbers. So what we are looking at here is in a savings vehicle earning 5%, the client needs to contribute about $6,600 a year from now until age 60 to ensure that even after taxes, even after growth, we're going to have $150,000. And so the total cost of doing that is approximately $99,000 over that 15-year period. The other option is, well, I have a lump sum of money today. I can put it into a savings account and I'm going to earn a rate of 5%. Sure. What you need today over the next 15 years is about $72,000, meaning that your total cost to obtain a fund of $150,000 is approximately $72,000 total over the same 15-year period. Now, here's where it becomes extremely compelling. For those people that are investing solely in RRSPs, in order to net out $150,000, assuming a 46% marginal tax bracket, in 15 years' time, your RRSP portfolio has to be worth $277,000. That's significant. And then, of course, there's always people that say, well, I can take a loan out or I can use my line of credit. That's perfect. Fantastic. I mean, if you have the ability and if you want to do that, here's my challenge with that. Let's assume you use a line of credit at a rate of 5%. Inevitably, your intention is to pay this back. And so the question is, how long is it going to take you to pay back that loan? Or how long is it going to take you to pay back the funds on your line of credit? Assuming it takes 10 years at a rate of 5%, $150,000 costs you $194,000. And then I've had the same conversation with a couple of real estate investors and a couple of clients that say, well, I can take an equity line of credit against the value of the property and I can amortize it over XYZ. And I say, that's fantastic. So if we amortize this over a 25-year period, the financial planners in you are already saying, well, who would do that? Well, the interest cost on something like that is going to mean that $150,000 cost this client $266,000 if it's going to take him 25 years to pay it. Nobody is going to do that. CI, I don't know how much CI is going to cost this 45-year-old individual for $150,000, but at its core, without any fancy bells and whistles, without any riders or any of that sort, let's assume it's going to cost $200 a month. And so on an annual basis, we're going to spend $2,400 a year for CI. You tell me, folks, what is better from an out-of-pocket cost perspective? Is your client willing to extract dollar for dollar from their savings? Or is your client willing to invest an annual contribution of $6,000? Now, here's the interesting thing. What if this happened 5 years later? We know an illness can happen at any point in time. And oftentimes people think of time and say, well, that's not going to happen to me. I have a long amount of time before I invest. But what if this illness struck 5 years later? How many clients do we know that can contribute $25,000 a year over the next 5 years into a 5% vehicle to net out $150,000? Very few. And so in my opinion, insurance of any kind, whether it's critical illness, disability, term, participating whole life, is a creative tool. So I want to thank you for your time. I hope the presentation gave you some valuable talking points and some sales ideas that you can actually go out and talk to your clients about as well.
Hello, hi. Is there any other question that people have right now?
Times, I guess there's a lot of variables that go behind
Oh,
that.
sorry.
Hi, Nanette. Okay, you can. Okay, any question? I have a question for you.
Sure.
About the investment growth. When you compare the other investment to whole life, right? You are using the interest, assume they put into the interest. So in
Yes.
that, the tax will be the highest, right? For the
Correct.
interest. Yeah. So what if the client say, I never put things in the interest, I'll put into the capital gain, right? So,
Yeah, that's a good question, Amy. And so we've run very similar examples when we take a look at putting things in the deferred capital gain. So I'll share with you a case that we worked on, this was about a year and a half ago. And we use the idea of levelizing the tax. Right? The idea of levelizing the tax is you have your investment portfolio that is going to grow at a 5% rate. And we had looked at a balanced portfolio at first. When we changed to a deferred capital gain scenario, the difference in income taxes between like balanced portfolio interest rates, which also included some deferred capital gains, or 100% deferred capital gains, the difference in that specific case, the interest on the balanced portfolio, the taxes payable on the balanced portfolio was about $400,000. When I changed that to a deferred capital gain, it was about $392,000. So to your point, you are saving a little bit, but 392,000, 400,000, it's very similar. The only difference is you deferred that gain, right? It's just being deferred to be paid at a later point in time. And the other variable now, Amy, is, depending on the capital gain that they're investing in, as I said, if it's real estate, we don't know what the capital gains rates are going to be like. If it's stocks and bonds, if it's corporate class mutual funds, which is the one that I often get, because corporate class mutual funds are all deferred, The tax bill is going to happen at some point in time, and it will still be punitive. It might not be as high as interest rates, but it will still be punitive.
Okay, good. And any other question? I think Rudy also mentioned about the provinces, right? If you are going to other provinces, they might have some different effect on the will and the probate fees and all that, right? Probate fee, I think, is the same, right? Probate fees.
Yeah, but even the wills and transfer of ownership, Amy. So there was a question recently that came up. Again, last week's business builder dealt with the intergenerational wealth transfer, and there was a question that came up with respect to joint ownership. Right. So if two parents buy a policy on the life of a child, and both parents are joint owners, what happens if one of them dies? Does the ownership automatically transfer to the wife? And the advisor that raised the question said, the ownership goes to the estate of the deceased individual, and the transfer is not going to be tax free. And so we did some digging, and in Ontario, when we apply for a policy with joint ownership, it's joint ownership with right of survivorship, meaning that if my wife and I own a policy together on the life of my oldest daughter, if I die, the ownership automatically transfers to that child. However, that does not apply in Quebec. And the individual that raised the question was actually an advisor from Quebec. In Quebec, what would happen in that particular situation is the individual ownership would default to the estate of the deceased as well as the surviving spouse. And so his practice is not to do joint ownership. His practice is to do one owner with the second parent as a contingent owner, because then it rolls over automatically. So keeping in mind how things are handled from a province to province basis, depending on where your clients are, is extremely important, both from a tax perspective and from a will planning perspective.
Great. So this is so important when we do the ownership for the children. Ontario, we are okay to do joint, but if you have someone in Quebec, you have to be very careful, right? But then another good choice is to get one ownership, because if they get divorced, it's also very difficult. Sometimes they don't talk to each other, right? So I always
100%.
tell my client to get the mother to be the owner and the father be the contingent owner.
Yes.
In that case, if there is any changes, at least the mother can be the one who have one say. You don't want to have two say, you want to have one say.
Exactly.
Yeah, because right now we have to think about that, right? So when I do advise to my client, when they talk about divorce and all that, we have to go into the divorce rules, to explain to them when you come to divorce, even though you put the people, like your spouse, into your your operation or your company or not, they still get 50% ownership, virtual ownership, right? So like it's not whether you do it or not, but sometimes I recommend them to do it together, is because they have the capital gain exemption. Two of them have capital gain exemption, right? Anyway,
Exactly.
so like this is very good, and at least we know that in the investment growth, I will show you after Rudy, then even if you put everything in capital gain, we are still ahead of the game, okay?
You got
and
it.
even if we are doing a corporation, you do the corporate borrowing, we are still ahead of the game, but we have to put some money to pay some dividend tax when we take it out, right? So this
Yes.
is another way of doing it. So thank you very much.
My pleasure. Thank you guys very much.
Yeah.
Have
so
a
I
good
think
afternoon.
yeah, and also maybe if you have the PowerPoint, anyone want to have the PowerPoint, you can send it to us and we can see who want to come with the PowerPoint, right?
Yes, please. I'll send it to Taro,
Yeah,
and
then we
you can
see what
share
we
it as
can
well.
do. Yeah. Okay. Thank you very much. Okay. Stay
Okay,
on.
thank you. Have a nice day.
Yeah. Thank you. Hello. Stay on, everyone, please. And I want to do a team meeting together with Nima today. Okay. And I want to share my screen. Okay. Before I do that. Okay. Now, Nima, I have a few questions for you, because after Nima's sharing, I have some things to show people how to do the a comparison using your software. because the way Woody do it is with the PowerPoint, right? And people want you to show them, how do you do it? How do I see it? You know, there is software. I think one Equitable is the easiest software to use when you do come to a comparison of the alternative investment and the whole life, right? So like Nima, are you here right now?
Yes, I'm with you.
Yeah. So can you let me know? I know that when you first started the business, right? Because you have a book of general insurance business, right, from your family. And then you always like to do the term insurance. Remember that? Or you say that, oh, maybe universal life, right? And then I start to tell you that you should think about some whole life policy, right? So can you tell me your role of evolving, you know, from a term policy to whole life? Can you share to us a story or something like that?
Yeah, absolutely, Amy. So when I joined the business, obviously, I've been grown in a family business of insurance for 40 years. So I always had some exposure to various type of insurance it's out there. When I started the business, naturally as a low entry point to the market, term insurance had become my focus, just to protect the families for the liabilities that they may have. But very soon, I learned that term insurance is like a diaper, a baby diaper. It expires after 20, 30 years, and it would leave the family with no coverage for the years to come after that, perhaps at a very much higher age, older age, when they cannot get insurance either because of the health condition or because of the cost. And also, over time, I learned that whole life plan is a very unique instrument. There is no other plan that you can go with an absolute confidence and say that it is going to increase your net worth, 100% guaranteed, and definitely tax exempt. And these two feature a guaranteed net worth growth plus the family protection and with the tax exempt feature made me convinced that this is going to become my focus.
And I think you have a winning case, right? That you start your you talk to your client, and then they have a good chance of getting into a term policy, but you convince them that the whole life can help them in the estate planning. Am I right?
Very true, Amy. When I'm having a conversation about insurance, obviously I start from term insurance, but I always have a very quick transition to the whole life insurance and why whole life could be a better choice for them. And quite frankly, many of the clients that I have now, they are either get the term insurance just to cover themselves and plan for a better whole life, or go straight to the whole life.
Yes, yes. And I can see how you change your practice, you know, from a whole life policy to more like from a term policy to more whole life policy. And then you are right beginning, right? When you mentioned that you want to protect the family. That's why I always tell my client to do the cash flow and see how much they need. And then after you do the net worth and the cash flow analysis, we know how much they need. We can suggest how much whole life they can do, right? And then if they are the people who have the money, then you can show them that is the whole life can help you to compare it with other investment, right? And then in here, I'm going to show you something, right? It is a insure retirement planning, okay? And then I'm going to choose $29,000 for policy for 20 years. So when he is 45 until 65, they have 20 years, they pay 29,000. And over here, you can see that is the investment. The investment I'm using is the everything on capital gain, 6% capital gain. That means the tax that we are talking about is not overstate, is the lowest, only 25% tax if you have the highest tax bracket. So when you come to here, you can see the very simple that even if I do that, and then when I'm 65, I get 121,000, right? Because there is no shelter from my investment, right? So it is all here. And after that, you can see I cannot draw anymore. as a whole life policy, I can borrow from the bank. I can still continue for it until 65. And also the net worth, the net estate is still continue to be a high value, right? So you can show to the client that, oh, I'm doing it for you. You can see my comparison of the investment. I use the detail, I have choices. I can do 100% interest. If I do 100% interest, then you will find out that I have to pay more tax. But if I use dividend, it's a little bit lower, okay? And I can also use deferred capital. That means I don't pay any, I'm not selling any of my investment, or I sell it. I continue to sell it. I have stock, I have investment, continue to sell it, but I have 6% return. So we can look at that. And even if this, I think the lowest is here, the defer. Even I put everything I don't sell, okay? I leave it, and have 6%. So even with that, I can show you, you can last a little bit longer, but not as long as the whole life policy. So if I use the, you can see I can last until 76, a little bit longer. Before I can only last until 73. Because I use the defer, I can last a little bit longer, 76. But then the reason is because the insurance that is no, all the accumulation is tax shelter. So that is a simple comparison with the lowest tax on the investment. We are still ahead of time because no matter how low is the investment, you still have to pay some tax, right? So that is the way I'm showing my client when we come to the preferred, like it's a personal preferred insured retirement planning, right? And then we can use the investment and do the comparison and show it to the client, right? And then for that, you can put it as a default, 90% cash surrender value up to 90%. So the borrowing can come to 90%. As I mentioned to you, some of the company, they make this at 95%, some of the bank. But then in here, if you want to make it 95%, you have to call us. We have to put it into another software to do it. Our regular software can call only up to 90%. And the interest rate, we use 4%, you can use 5%, 6%. We can change a little bit, but 4%, 5%, I think is still reasonable right now. And then for the marginal tax, we use 50%, supposed to be 53%. And dividend tax, dividend rate 45, they also take care of all the eligible or non-eligible tax dividend rate. Okay, so this is the basic.
Sorry, Amy.
Yep.
Quick question. The small business corporate tax for active income is around 12%. And
no, this is a private. Okay. I'm not doing this one. Is a private. I'm not talking about the corporation.
Okay, thank you.
The corporation has another way, right? Today, I don't know whether if you want to look at that, you can look at my corporation. Okay, so here, I'm using the private. Okay, sorry, when you are talking, I'm doing all the illustration. And then if you do the corporate, it's a good catch, right? The corporate is different. Okay, it's 12.5%. They know, right? But when it comes to investment, it still come to 50%, right? And they have eligible dividend or non-eligible dividend. I put it there anyway, but because if we have a preferred share, we don't have any non-eligible dividend. Okay, yeah. So right now, the one I have before is only when you put into the dividend, you have a eligible dividend tax rate. Okay, so now we come to corporate borrowing. Okay, the corporate borrowing, we can do the shareholder borrowing and corporate borrowing, but let's do the conservative one, right? We use the corporate borrowing in that case. Remember, if you do a personal one, you get 121 loan, but when you do the corporation borrowing, because you have to pay some tax on that, you can only get 66,000. Remember that, right? 121 to 160 because I pay tax on that one, right? And same as I do it with the, you see, even if I do an alternative investment, right? Then they have no value after they die. In here, they are almost the same because I have to pay tax, they have to pay tax. The difference is not as much than before, but then you can see we still have some that benefit to share with the client family. Okay, so there are 894,000 as an estate tax, but in here they don't have any. Okay, so this is something that is in the corporate world. Okay, but that is the software is already very easy to manage. Okay, so that is the way. We have all the software in different company. You can go and play around it, right? So I'm just using it to confirm to you that we are able to use it to compare the concept. When we come to the concept, we compare this is the personal retirement planning and the corporation. And the corporation retirement planning, if you use the dividend, there are two ways of doing it. If you do the shareholder borrowing, it'll be the same rate as all the thing will be the same as what you have in the personal. However, there is a lot of things you have to be careful when you do the shareholder borrowing. I'm not going to touch on it now. You can see you have to have a guarantee fees, and also we have to have a guarantee fee. And also when when the person die, how are we going to pay off the loan? We have to make sure that we use the personal assets to pay off the loan. So there's something that you have to arrange it when you come to the shareholder borrowing, and the accountant is against it. So we don't want to show it to the accountant. You will get they will be the same price as what we have. It's a personal, right? But there is some guarantee fees. They is not putting in here, and this thing is shown nicely. But when you have to deal with the accountant, I rather help asking you guys to do the corporate borrowing instead of shareholder borrowing. And unless the accountant is a very open-minded accountant, you can talk to them about that. You don't want to argue with the accountant. That is the idea. Okay, yeah. So this is what I want to talk today. And also, like you can see it for Nima, that I can see the changes from him only doing the term as a general insurance broker to talking to people about the investment. And I know that Nima is from Iran. So if you have any Iranian client, you can come to Nima, she can take care of it. We also have people who are from India, okay, and from Sri Lanka, and from different Filipino, Korea. So our company have a multicultural company. And then if you need to have someone to talk to them, you can to share the case, please feel free to let us know. I personally do share case with a Korean lady, and then because my client doesn't, the lady, what happened is the doctor, he speaks perfect English, but he wanted me to talk to his father. His father have nothing to do with English, only Korean, So I have to get one of my staff, one of my broker to be a partner. We are dealing it together, and he speak Korean to the father, and to get the case done, right? So that is the way that why if you have anyone who are Middle East, and Iranian and Middle East, you can come to us and we can refer you like Nima and whoever you like, come and introduce you some connection. A lot of time when you talk to Filipino, for example, you have some Filipino client, you want to ask some of the Filipino to deal with them together, please feel free. We have many good Filipino agents here, right? So like in our group, we have Mandarin speaking, Cantonese speaking, we have Middle East from Iran and other Arabic speaking agent, and we have Sri Lanka and India and Korea, Filipino and Vietnamese. Okay, so that is my company that we have different people, right? Right now I have one Vietnamese agent, and she's very nicely, she loves to do servicing, so if you have any people who speak Vietnamese, you need someone to talk to them, please feel free to let me know. Connection is very important. A lot of time I want you guys to have a good connection with the client, not only showing the number. Number is everybody can show the same number, and a lot of number is, I think it's too complicated for the client. It's where the heart go to, okay? Yeah, and my suggestion is to keep everything simplified, not complicated the thing to show the client that you are very capable to get the to get into where you are. You want to show the client that my purpose is to let you know what are we doing with you, so we make sure that you understand our our way of doing things, in a simple way. And at the end, if they want to make sure that everything is done professionally, then I ask to talk to the accountant. I love to talk to the accountant, so like I'll go to have a Zoom meeting with the accountant, explain to the accountant what's going on, except you make sure the accountant is not an agent. There is a lot of accountant, they get the license, so like when you have a lot of challenge from the accountant, sometimes you have to do some research. This accountant may be they want the client business, right? So that is something that we have to be very careful, because a lot of people, they are accountant, they get the license, they want to get all the client business. Then we have to say that we cannot say they are not good. You just explain to them, whenever you do anything, it's good to have a second opinion, right? If a person doing everything for you, you might not able to get a second opinion, right? So never badmouth anyone, but just to explain that why we are better.
Yeah, I'm working on the wire because it was wireless and 5G, so I connected to the wireless. But I lost her.
Yes. Okay, we can talk later. I know that you are coming to the office, Robert, right? I can explain to you, right? Yeah, so like, and also Robert, you have some good cases as well, right? We are going to work with your client, right? So like when you have people like Robert, he has a case, he come to us, and then we look at the whole picture, and I give him a lot of ideas, and so he go back to see the client, and this is how we close the case, right? So we help our client to, when you have some good case, you let us know, and then I look at the big picture, I will let you know what you have to deal with, how you can deal with it, right? So hopefully that make you make people feel that you are very powerful, because you have the whole team from us backing you up. Yeah, I have one new agent who get her first case, because I give her all the step 1 to step, like all the steps thoroughly, and she has an excellent memory. She went back to see the client and get a very large case placed, and then when the client asked her all the question, she answered it, because I told her they will ask this question. She memorized it and answer all the questions. And the client said, how long have you got your license? Oh, two weeks, right? How do you know more than what I asked the other people? Because I already predict what question they ask. So I told her, you can talk to them about all these questions. They can be alone. I don't need to be there, but unless they really want me to be there, I will be always together for them to see the client. Okay, yeah, so that is how you can make use of our connection in different culture, and you can make use of our connection with like all the cases, how to structure the cases. And also the other thing is, if you have people in Vancouver or in other places, let us know. We have people over there, we can help. A lot of time they want to have someone over there in the different province, and then we can connect you with other broker as well, right? The most important thing, remember, is the client interest is our priority. So this is what you have to know, right? And then collaboration is better than working alone sometimes, and our company will, Taro is keep on getting advancement on her knowledge, and she's getting a lot of destination, because we want to know how to professionally structure a lot of cases, so that is something that we are planning to do. All right. Okay. So any other question for anyone? And if not, I leave it to you for the good week, and I think we can go to see more client right now, and just to connect with them and see, just talking to them. We not necessarily go to see them and say, hey, I want to give you some insurance. No, I think it's very important. I think I have a very special skill is to talking to people. And when through the conversation, I am able to pick up what I can feel, like, what do they want, and I'm satisfying their want. So in the conversation, when you go to visit your client, not necessarily saying that, oh, we need to do analysis for you. You can just say that we want to catch up with you about your life, after the pandemic, right? So in that case, you are able to capture what is the thing that you lose the information from, and then you are going to catch up everything from them, and then tell them, share with them and see what they want and see how you can help them. So hopefully everybody go to see all your friends, you know, just to say hi, and then capture what they need to, what they want, and then try to see what our profession can help them in the future. All right?
Hi,
Okay.
Amy. One quick question. Amy, sorry.
Yes,
Amy?
it's Nanette. Yes, I'm here.
Sure. Okay, just quick question because I have a client dealing with it last night. What is your opinion regarding the buying the house? Sorry, buying the house or getting a second property or buying a participating whole life?
Okay, you know what? It all depends on the priority of your client, right? So in that case, even though you say that second property, which is an investment, right? And then they can also borrow money to get the investment, right? The second property. It's not that, let's say they have a $1 million property to put into it. You don't have to, because you say that, do you have the, to have you get your down payment? Okay. So let's say if he already have that down payment, right? You can just put the down payment in and have the second property, and the second property is going to rent out. Am I right? The second property, they rent out the second property.
Just rent out, but their dilemma is either they're gonna get that equity because the first house is already paid up, so they're trying to purchase another property for rental. But I showed them the par insurance, and they can maximize that one from the proceeds from the equity of their house. And at the end of the day, that par insurance will be paid up in 20 years. And they still accumulate that because I know it's good for estate planning someday, and it's all tax-free. While the second property, remember the capital gain. So the capital gain, half of that will go to tax only anyway. Right?
Okay.
So what is your opinion regarding that?
You know what? I would suggest them to do both.
Both.
Okay, to do both. Yeah, we will talk about how to make them to do both.
Okay.
It is possible, okay, to do both. Okay.
Please call me if you have time. I know
we talk about that, right? Because we have to know more about the property, how much they have, and then we will see how you can accommodate them to do both. So in that case, the insurance can help them to do the capital gain in the future, taking care of the capital gain. At the same time, they still have the second mortgage, second properties. All right, we can arrange it. If we can have a way to get them to do both, they really like you a lot. Okay, let's do it.
Actually, I closed it already last night, but I just need your second opinion. How
there
is it
still
good?
possible. Yeah, there is still possible to get the property. Okay.
Okay, please call me later.
I will do
Thank
that.
you.
Okay, thank you.
Thanks.
Yeah, so like something like that, we will look at into the detail, and then I always have cases bouncing here and there with me, right? So just continue. Hopefully, you know, it's a lonely business. I hope to share a lot of idea with my brokers. Okay.
I always learn a new thing from you. Thank you so much.
Thank you.
I encourage everyone to always attend because we pick up, you know, important small things, but it helps us a lot in our business in day-to-day living. So thank you.
Thank you very much, Nanette. Okay. Okay. So have a good sales this week, you know, and let's see each other next Thursday. Okay.
Okay, thanks.
Bye-bye. Bye-bye.